Leverage. So in finance, leverage generally means using borrowed funds to trade or invest. So leverage is actually credit in finance. So in this market, we have leverage. So the Forex brokers offer trading accounts with a certain leverage. And this leverage is measured like 1:100, 1:200. That's how they measure the leverage. So if you have maybe a leverage of 1:100 on your trading account. So if you choose that your leverage it should be 1:100, what does it mean? If you deposit 100 USD out of it, you times that by 100. So you have like 1, 1, 2, 3, 4. So your capital will be like 10,000. So if you deposit 100 USD, your capital will be like 10,000 USD. That's the amount of money that you can use to trade the foreign exchange market. But you do not actually see it on your trading account. So these FX brokers do not offer actual credit, like you will not see the credit, but they allow leverage via margin trading. And what is margin now? Margin is the amount of funds that a trader must have in the trading account in order to keep a position open or a position running if it's going on loss. So brokers often define margin as a percentage of the total value of a pair trade. So each pair will have their own margin required to trade that pair. And a pair that has the lowest margin from what I've experienced is AUD USD. So with AUD USD, you can trade an account with very, very little amount of dollars, because it requires very, very minimal margin in order for you to open a trade on AUD USD. But when you want to trade maybe gold, a commodity like gold, gold requires higher margin for you to trade that. So perhaps it might require you to have at least $15 on your account in order for you to take a 0.001 position on gold. So it will require an amount like that. But for Audi USD, you might have $2 to $3 on your account, and you might take 0.01 lot position on Audi USD. Okay, so that's how the leverage and margin works. So suppose you are trading, You are trading, and when you're trading, your trade goes against your anticipation, and you do not have enough funds to cover losses for the period that they hold your trade open. You will receive what we call a margin call from the brokers that you should either close your money losing trade, or you can transfer more funds into your trading account in order to keep your position open because your margin has fallen below 80%. So for example, you have $100 account, $1,000 account, $10,000 account, and you are holding your trade position on a $10,000 account, and the margin has dropped below 80%. So you are holding maybe negative 8,000 on loss. You will need to transfer more funds into the trading account in order for you to keep your positions open. And if you ignore that, you will find that if the trades still go against you, so brokers would automatically close your trades as your account goes to zero. Therefore, the whole margin that you have in your account will be wiped out. And there's what we call burning an account. So you have burnt your account. And that is where risk management come into place. You need to know how much you should risk in a certain trading account in order for you not to receive a margin call. Because you need to be there for the next winning trade. So if you lose this trade, you need to be there for the next winning trade. In order to avoid the margin call, you need to be using risk management to trade your account. So despite having the margin call, some brokers tend to bear losses in case a popular trade goes against their traders in big way. So for example, many traders have taken maybe gold trade and high volatility occurs and it goes against many of their traders. You'll find that most traders' account would have negative balances. So you find a trader's account negative, having a negative $200 balance. That means the brokers have actually incurred loss in that. Okay, so the brokers have actually incurred loss because the machines were not able to close the trades because of the high volatility that has occurred during that trade when the trade was open.